From the University of Virginia Darden School of Business, welcome to Hot Topics in Finance. Today's guest is Jim Cooper, MBA class of '84 and managing partner at Thompson Street Capital Partners.
Well, it's had a huge impact on my career. I came to Darden with an engineering background, and when I got here I remember telling my father, I don't know why I'm going there, but I think there's something out there for me. And I had no knowledge of accounting, no knowledge of finance, no knowledge really of investment banking or commercial banking. And after the first year, I took a real interest in finance and sought a summer job in New York with JP Morgan. And my career has really just evolved from there. The second thing, we had a very good class. We had a lot of people that went to Wall Street that summer and ultimately ended up there. We all stayed very close. Once we got up there to work, we're frankly still very close. And I think that was a big influence on how my career developed. Well, private equity is really, it's a 25-year-old business. And in the very first years where I was not in it, but I was observing it as an investment banker, it was very inefficient and lots of leverage and frankly very, very high returns, which is not surprising given the inefficiencies. As the business matured and more money was attracted to private equity, more firms were developed, there was more money to deploy, you obviously saw more competition, the inefficiencies started to work their way out of the system and returns began to drop. So the world that we're in right now it's frankly much more challenging because you don't have the obvious ability to buy a company on the cheap, sit on it and be able to sell it higher. You've really got to do things. You've got to get your hands dirty. You've got to improve a business. And that's always been the case to some degree. I think it's never been the case to the degree it is right now. Well, it's certainly not a dying industry. It's a great career, and the people that are in it don't want to leave it, and there's reasons for that. The people that invest in it are frankly questioning the model and the pricing to some degree. That's probably okay, but there are billions and billions of dollars invested in private equity, and that's going to continue. So it's the closest thing to being an entrepreneur that you can have sort of in finance, because you're very involved in each individual business. And I think that's an attraction for a lot of people. It's just a tougher business model with sort of a slower growth economy, less leverage, and lots of money to deploy into the business. Well, they've been very important in the last few years. I mean, we've said flat is the new up, which means if your company was flat, you were cheering, and that was never the case. That's as we went through the recession. I think modestly up is the new growth model. So there are new things. I think the biggest reset is in expected returns. I think that when I got into the business, an investor expected you to return something around 30% IRR in a given deal, which would translate into sort of a 20% net IRR to the investor. I think those expectations are significantly lower today given the market and given the maturity of the business. But as long as you're generating a return that's in excess of an alternative, an investor should be fine.